In May of this year, I did a video where I predicted rates would stay the same for the rest of 2023. Well, I was wrong, as were Zillow and Redfin and the National Association of Realtors. We all predicted rates would come down or stay the same. Instead, they're going up. What is going on? Well, hello, I'm Wendy Pinnell, and the economy and inflation just have not cooperated this year at all. Seriously, how can you raise rates 13 times in a row without hitting a recession and seeing inflation bottom out? But unfortunately, nothing about the economy has made sense this year. And none of us are happy with the Fed, who put us here in the first place. And it's not as though the Fed has no history to learn from, right? We've already been here with hyperinflation. We saw it happen in the 70s. Jasper made an insightful comment in his article, Striking Similarities and Differences Between Inflation Today and in the 1970s. In the article, he compared the two time periods and he made this comment. He said, U.S. monetary policy reacted fast in the early 1970s. As inflation started rising, the monetary policy rate was hiked almost immediately. Then he continued, the Fed at least got the timing right in the early 1970s. Unfortunately, for those of us trying to buy, sell, and just generally live today, the Fed definitely did not get the timing right this time around. We saw inflation going up, the Fed didn't act. Then we saw it going up more. The Fed labeled it transitory and still did nothing. This is their whole job. And they should have already learned from the 70s, right? It's like they missed their entire job description, and their timing mistake has led to what we're seeing today. And this is what you need to know. The Fed has a dual mandate. They're supposed to both maximize employment while controlling inflation at the same time. And if you don't know a whole lot about either of those things, there is a very fine line in which you can do both of them well. Basically, it's like walking a tightrope. And in this situation, in the 2020s, let's put it this way, the Fed is no circus star. In fact, let's dig into the great tightrope fall, also known as the Fed waiting way too long to control inflation. In his study of the 1970s Great Inflation, Jasper shares how we can see exactly why their timing was such a mistake. He says, despite the rise in inflation during 2020 and 2021, the Fed funds rate was kept at 0%. When the Fed started raising rates in March of 2022, inflation was already running at a red-hot 8%. In other words, by the time the Fed decided to take any action to begin fighting inflation, inflation rates were extremely high and difficult to control. He continues on the subject saying that two problems follow from this late reaction: the risk of monetary policy miscalibration and the risk of inflation becoming broad-based and difficult to combat. So which problem are we looking at today? Well, according to Jasper, with respect to the first, we're gonna have to wait and see whether the Fed ends up raising rates too fast to make up for the late start or too much. It's really too early to tell. But the risk that policy will be miscalibrated is higher when the policy intervention is delayed. Then he continues, with respect to the second, that inflation becomes more difficult to combat, there are already signs that this will be the case. Okay, so great. We're looking at a definite second problem and potentially a first problem as well. Arguably, the biggest problem the Fed has encountered has been the job market. Remember, they have that dual mandate to maximize employment and control inflation. Well, the problem is the Fed needs to see wage growth slow down in order to control inflation. And they can need that until they're blue in the face. But the truth of the matter is, wage growth hasn't slowed down as much as it needs to. In fact, let's take a look at the most recent job numbers. Reuters fills us in on U.S. job growth, saying U.S. employment increased by the most in 8 months in September as hiring rose broadly, pointing to persistent labor market strength that could give the Federal Reserve ammunition to raise interest rates again. So not only is this giving the Fed what it would need to see in order to raise rates, but Reuters also adds that labor market strength is helping to sustain the economy, with growth estimates for the third quarter as high as a 4.9% annualized pace, more than double what Fed officials regard as the non-inflationary rate of around 1.8%. So why is that? Why is the labor market so strong in spite of the Fed repeatedly raising rates? Well, what we're seeing is the result of the Fed waiting too long to take action in 2020 and 2021. Inflation has become entrenched. I mean, it's just what Jesper said earlier, okay? The Fed didn't take action soon enough and inflation became broad-based and difficult to combat. What we think, should be a simple like cause and effect. The Fed raises rates, the economy slows down. It has become far more complicated. In fact, if you want to see this in action, just consider how we all thought rising rates would make the housing market see a sustained drop, but that hasn't happened. The thing is, builder profits and cash reserves are high enough that they can offer discounted rates so buyers don't have to worry about the high interest rates. So what we saw this summer instead was a Dallas housing market that's not really being held back. We still saw plenty of qualified buyers, right? Interest rates going up is inconvenient to them, but builders are helping out, and their income is enough that it doesn't stop them from buying. So despite interest rates continuing to skyrocket, there are all of these variables that keep the Dallas market chugging right along. Right? Inflation is entrenched. Now, this is an important point that probably a lot of us haven't really considered. And here it is. Major companies had plenty of time with rates near zero to raise cash at cheap rates so they could ride out the storm when the hiking cycle began. And guess what? If the Fed had acted earlier when they should have, these companies wouldn't have had so long to raise cash reserves. All right, now here's an example. We have friends who own a bunch of furniture stores. All during the 2020s, they would use cash to build a new warehouse. Then they would obtain a loan for it after the fact. During the construction process, the value would skyrocket. So when it was done, they'd go to get a loan. The warehouse is what, like maybe doubled in value, and they're able to get that much cash in the form of a loan. So they can pocket that much cash and still keep their costs low because they're getting such a low interest rate. So picture this happening again and again across America with thousands of companies over the course of 2 years. To a degree, the same thing happened with consumers. They were able to significantly build up their cash reserves. For example, they could do this thing through things like cash out refinances. Okay, home values were up, interest rates were down. Your average homeowner could do a cash out refinance, pull out like $100,000 in cash and probably still have roughly the same monthly payment. Inflation started going up by mid-2020, and that's when the Fed should have started raising rates. Instead, they waited until March of 2022. I mean, picture the amount of homeowners who could do cash out refinances between February and June of 2020. Okay, that's what, like 5 months, right? So June is when inflation first started going up, right? Instead, the Fed let it go on for 2 full years. So if you had, let's just say 100,000 people, do cash out refinances between February and June, right? You could have maybe 400,000 people doing cash out refinances since the Fed held rates down for so long. So picture all of these people with that extra cash. Fannie Mae hits the nail on the head when it says the pandemic-related fiscal transfers and built-up household savings have supported consumer spending longer than we had expected, providing unforeseen support to the macroeconomy. That's another way of saying both companies and consumers have a whole lot more cash than they expected. They're gonna run out of those reserves eventually, but doesn't this make sense as to why inflation hasn't made it to that magical 2% or why, the labor market hasn't softened? I mean, let's say giant company number one has 500 employees, but $1 million in reserves. They can wait a long time before they have to start doing layoffs. In light of all this, Fannie Mae does believe there will be a mild downturn the first half of 2024, predicated on the belief that consumers will begin pausing their spending, in part due to the exhaustion of those funds and having to realign to a more sustainable relationship between spending and incomes. So when we ask ourselves, why isn't the Fed finished? Why are we hearing higher for longer? Well, a few reasons among many are that both companies and consumers were able to build up a lot of cash, and they've been just fine so far. And what's our end result? Well, interest rates that have to stay higher for longer. Reuters points out the labor market and the broader economy's resilience 18 months after the U.S. central bank started raising rates to cool demand suggests that monetary policy could remain tight for some time. We need those companies to run out of their reserves and those consumers to run out of their savings in order to really see the effects of monetary tightening. And the Fed's not going to lower rates until we see that. In fact, we need to see them not lower rates until that happens. I mean, as much as we all want to see affordability return to the market through falling interest rates, we need to remember what happened in the 1970s. The risks of lowering rates right now are just too high. In the 1970s, the Fed responded too quickly and lowered rates as soon as inflation started going down even a little bit. The result was that inflation roared back with even more ferocity than the first wave, and it took higher than 18% interest rates to finally get inflation back under control. So imagine today, if all these companies still have cash reserves and rates go back down, they're just gonna go right back to generating cash through cheap credit. For them, it'll be as though monetary tightening never even happened. The Fed knows this. They know they screwed up by waiting so long to start raising rates in the first place. They want to prevent a 1970s repeat and restore their credibility at the same time. And so we hear that dreaded phrase, higher for longer. I imagine right now you're probably wondering, okay, Wendy, how much higher and how much longer? Well, great question. Let's check in with the experts. Up first is Fannie Mae, and it hits the nail on the head when it says how mixed signals from key economic data releases continue to muddle the near-term outlook. Well, thanks, Fannie. Okay, that was really helpful. Well, luckily, she has more to say, though. Fannie Mae puts the average 30-year fixed rate at 7% during the third quarter of 2023, ticking up slightly to 7.1% by year end. The mortgage giant doesn't expect rates to dip below 6% until 2025. Well, given that today's rates are close to 8%, we already know that Fannie Mae is coming in too low. The Mortgage Bankers Association shares that assuming the spread between the mortgage rate and treasury rate narrows as rate volatility settles and the monetary policy outlook becomes less uncertain, we expect mortgage rates to decline gradually at the end of 2023. Now, quite a different approach than Fannie Mae took, and yet they're both coming in more conservative than what we're actually seeing. Now, Wells Fargo chimes in on this too. Wells Fargo puts the 30-year conventional mortgage rate at 7.1% in the third quarter of 2023, pulling back somewhat to 6.75% in the fourth quarter. They continue saying, the bank's forecasting group predicts that rates will fall below 6% in the third quarter of 2024, with the Federal Reserve keeping monetary policy tight until it's confident that inflation is back to the 2% annual target. Well, how about Realtor.com? Well, Realtor.com economist Jeju states that the trajectory of mortgage rates hasn't unfolded exactly as we expected. Yeah, you think? He continues, we anticipated higher mortgage rates early in 2023 and a gradual decline as inflation pressure retreated, but we've seen almost the exact opposite pattern. We still expect that mortgage rates will reverse course and trend downward if improvements in inflation persist and show some sticking power. Mark Fleming, chief economist for First American Financial Corporation, shares his opinion on the matter as well. He says it's likely that mortgage rates continue to hover in the 6.5% to 7.5% range for the remainder of the year, which means affordability will remain a challenge for many homebuyers. Palisade Group Chief Investment Officer Jack McDowell states a similar prediction. While over the medium term, we expect a normalization bringing mortgage rates back to around 6%, predicting the timing is challenging. In the near term, our base case assumes mortgage rates tighten 25 to 50 basis points by the end of the first quarter 2024, or 7% to 7.25%. So we have all of these industry experts, and almost all of them are coming in lower than what we're actually seeing in the market right now. Okay, but enough from the outside experts. Let's talk about what the Federal Reserve itself is saying. Dot plot shows the Fed's predictions. The Fed's latest projections show that 7 officials see no more rate hikes this year, while 12 see one more. If you look closely at the dot plot, there's even one member who predicts rates will go up another 0.5 point from where we are now. Your most important variable right now is watching for when consumers and companies exhaust their cash reserves. Only then are we going to actually see monetary tightening doing what it's supposed to do. On a local level, do you think all those new construction companies will be able to keep offering discounted rates when they run out of reserves? I mean, I love the forward commitment. And if you're not familiar with the term, Devin Bachman explains it best. He says it's when builders purchase forward commitments which provide tranches of money at below market rates to originate mortgages for their buyers. For our relocating buyers who don't have a choice about buying, it is a godsend, but I don't think it's going to last forever. We're dealing with finite resources, and the more builders are impacted by today's higher interest rates, I think the generosity on these forward commitment tranches will run out real fast. Your ticket right now to a lower interest rate is taking advantage of those forward commitments while they're still around and through assumable mortgages. In fact, I did a whole video explaining assumable mortgages that you may want to watch next. In the meantime, Wendy out.